Hey, good evening, everyone. This is Bedtime Real Estate. This week we got a good show here. We got Robert Graybill from Fairway Mortgage. He's gonna go through the details on down payment assistance. Actually, go through the whole process of getting a loan. What are different factors that affect you from getting a loan, and what different factors that can that goes into the process. So, you have to be able to get the right professionals that work in those areas. And Robert is a person that works in the loan industry for years. So I wanted to have him on. So I'm going to add him to the show here. Hey,
Hello.
Robert, man, thanks for joining us.
Thank you. Thank you for having me. It's exciting. A late night.
Yeah, late night, man, just before people go to bed and either go to sleep or do other things. You know what I mean?
That's right.
So
Okay.
go ahead, tell about yourself, Robert, and then kind of what you've
Yeah.
done in the past.
Yeah. This in case you all are wondering where I am. I'm in my pool house that's unfinished. It's the quietest spot I can find on my property. So with my kids. So yeah, I've been in the business 20 years. I'm in my 20th year. I've seen a heck of a lot of ups and downs. And these high rates aren't going to be forever. So definitely more challenging now, but there's also some good in it as well. So um, my role is of course pre-qualifying people, but also doing a lot of hand holding. Unlike a bank where you just they pull your credit and they say no, they don't really tell you why, and really prepare people how to get there. So a lot of my clients are, want to buy, don't know which direction to go. What about their credit? And I give all that guidance, well ahead of time, and prep them for getting pre-approved one day, and then ultimately buying a home. So love what I do. Um, Helping people. So um, helped many families, and it's fun. So. Um, but it's definitely challenging now with the higher rates, and we'll get into that as far as if you should wait or um, wait to buy or buy now. When's a good time? We'll get into all that and all the programs, and yeah, um, that's all I got right now.
All right, man. Let's rock and roll. I'll help you stream through this presentation. So I'll go to the first page here
Yeah,
for you, man.
I'm gonna pull up on my iPad too.
Yep. Yeah, it's a little bit smaller when you're doing. We are using a special app called StreamYard. If any of you guys do like social media streaming stuff like that, it's a great program to use. You can, stream multiple people on there and stream multiple platforms. So, I'm not getting paid by this, but it's a great program so far.
Yeah, I like it. So, if everybody could see that, some of the five biggest myths of home buying is credit. I need to have perfect credit. Well, no. So, some of our programs you go as low as a 580 score. Um, Although more challenging when you have a 580 score to about a 639 score. Um, and some of the programs that we offer for first-time homebuyers, especially, is you don't get penalized for having a lower credit score, meaning you don't pay a higher rate. So if you go to a bank and have a lower credit score, you will pay a higher interest rate, more closing costs. But our programs don't hit you for that. So you can have a 620 score and still get a rate as if you had an 800 score. So you do not have to have perfect credit. We do soft pulls. We review your credit, review your credit, let you know if anything needs to be paid off or paid down, what not to pay off. Really give you that guidance. And again, you don't have to have perfect credit to buy a home. You don't have to be in the 700s. Number two is you don't have to have 20% down payment. We offer FHA, which is a government mortgage, is 3.5% down. We have conventional, 3% down. we have, and this is 1 to 4 unit properties. And if you don't put 20% down, you have something called mortgage insurance, which is an additional monthly payment that you pay to the bank in case you default. It doesn't protect you in any way, but all in all, you do not need 20% to put down your mortgage. So that's definitely a myth. You won't qualify. Well, if you don't try and see where you are, you'll never know. And I hinted at the beginning, it is more challenging now because rates are higher, home values are higher, so it takes more income than what it did when rates were 3%. It definitely takes more income, but there's other ways. Maybe we can add a borrower, maybe we can add a co-signer, which is somebody that's not going to occupy the property, but we can add their income to your income to help your buying power. But at least try. And we have a soft pull as well, which I mentioned. It doesn't hurt your credit. So, or you can go on creditkarma.com and see where your scores are, see what's might be holding down your credit. Just keep in mind, Credit Karma scores are higher than when we pull it, than when banks pull it. They will be higher, but you can use Credit Karma as a guide. It's very helpful. It'll help you. It give you hints and tips to build your credit and how you use your credit cards and stuff like that. So it's a free site too. I can't afford the monthly payment increase. Well, 9 out of 10 times I'm offering clients a 30-year fixed mortgage. The payment will not change, unlike your rent, which keeps going up and up and up. So I call rent an adjustable rate mortgage because you have no control over it. But a 30-year fixed mortgage, the only thing that can change over time is the taxes. Taxes can go up, or your home insurance could change. But you can always shop your home insurance at any time as well. But the payment's going to be fixed. Your rate's going to be fixed. Payment's going to be fixed. So it will not increase unless your taxes go up. And if they do, it's stretched over 12 months. So sometimes it's not that big of a deal. It's manageable. Home repairs are too expensive. So of course, what we've been seeing out here recently is many homes still asking top dollar and a lot of deferred maintenance. People haven't really kept up with the home and they're selling it as is. So we're seeing that a lot. So we do have renovation loans to cover that. And it's a simple, whatever the costs are to renovate the home, to get it the way you like, new kitchen, upgrades, cosmetic or structural, we will finance those costs into your loan. So for instance, if you're doing an FHA mortgage where you're buying it, or conventional as well, you're buying it, say, for 300,000 and it needs 50,000 in repairs, or that's what you want, then your down payment is based on 350,000. So if you're doing a 5% down payment, your 5% down is based on 350,000. You get a contractor, they do the work, and at the end you have the house like new, and all those costs are rolled into your new mortgage, and that's very manageable as far as not having to come out of pocket with your own funds. So those are some myths. There's a couple more, but Pedro, if you want to add anything there.
So are you telling me I don't have to get 5 Home Depot cards to fix my house?
No. And that would hurt your credit too. So yeah.
No.
Although I've seen people do it. Now, I will say, if there's cosmetic things and something that you can live with over time. Now, the renovation loans, the interest rates will be slightly higher than the regular mortgages, and the closing costs are a little bit more. So sometimes if it's a small thing, 5,000 in repairs, they say, well, you might not have the funds to do it right now, but if you can live with it and just get a regular mortgage and over time do that on your own with your own funds and not pay a higher rate. And then, but also, although not a big deal if it is a higher rate, because at some point rates will be coming down. If not the end of this year, probably not now, possibly next year. So these loans, these renovation loans, have become more popular because you can put all those costs into the loan, knowing that this isn't your forever payment. You'll be able to refinance as quickly as 6 months, but you'll be able to refinance hopefully by next year when rates come down, um, into a lower payment. You have all that equity built up now from the renovations, and you have a lower payment too. So it's pretty nice. Pretty nice to utilize
Yeah.
those programs.
Yeah, I would say that all these 5 myths, we definitely come across anytime we're talking to clients. And you know what the big mistake they make is that they start asking me some of these financial questions, but they're at least reaching out to a lender. You have to get
Mm-hmm.
someone in your corner that has experience and like that's part of the process of getting the pre-approval done. So that you should get them involved as soon as possible.
Yeah. If I can add one more myth, I think sometimes clients say, "Well, how much do I owe you for your time, and how much does this cost to do all this?" I
Yeah.
said, "Nothing. This is all free advice up front. So don't be bashful, and give me a text or a call, and we get paid at the end when the loan closes. So yeah, there's nothing up front for that guidance, and yeah, take advantage of it.
Free doesn't mean doesn't have value. Just let everybody know. Free doesn't
Yes.
mean doesn't have it has it's worth more than what you're getting. So,
Mm-hmm.
but
Mm-hmm.
so let me switch to the next slide.
Mm-hmm.
So this slide is talking about rents that add over time, which is definitely an issue that we're facing here in Lower Fairfield County. You got people that are trying to find places to rent, but it's very difficult. Like every corner in Fairfield County, the prices have gone up for renting, and there's been a time where during COVID where landlords definitely they got really the short end of the stick. People that couldn't pay because of COVID, but some people that decided not to pay. So, and that issue, landlords are tough now. They want to make sure that your credit matches up, your background matches up in terms of like type of criminal history, anything like that, and ends up happening, and they want their rent at full rate, and they're not giving discounts. So when people usually move out because they're on the lower end, they always hike it up. It's unfortunate because it puts tenants in a bad position because it's hard
Mm-hmm.
for them to get places that more comfortable for them in terms of building a family or maybe the school system they want, and they have to go up north to find housing that they afford.
Yeah, it's pretty tough now. Yeah, I feel for people. I mean, these rents are out of control in most, especially Lower Fairfield County, like you said. Yeah. But that's why we're trying to help people to get out of that rent and own something of their own and build equity and have a stable, manageable payment, and build stability in your budget in your life too.
Let's
Um,
see.
and let's see, Pego, let's see.
I can go to the next slide. We kind of talked about rents already.
Yeah. Um, yes, qualifying. Are you on the, sorry about that.
Oh, sorry, I missed a slide. I'm
I
on the
thought,
things to know before you buy.
oh, yes, yes, yes. Okay. Yeah. So I mentioned earlier, I do a lot of hand holding. So when I pre-approve somebody, I say, here's your maximum. Um, just so you know what your maximum is. We find out what towns you're looking in, and based on that, estimating what the property taxes might be. And then from there, I say, okay, here's your maximum. Here's based on your down payment. Um, here's what your monthly payment would look like at your maximum, and just so you have a number. And then at that point, the buyers might say, well, that's a little steep. I don't want to go that high. Um, you know, then we figure out what's comfortable for them. where do you want to be monthly? Um, what range, and then back that into a purchase price. And then we know what you know purchase price to look for and shop for, and that helps the realtor. So, and then ultimately, when a client's looking at properties, I say, anything that you like and want to go see, shoot me a text or email with the address, and then I'll plug in the exact taxes and say, okay, here's what you're looking at monthly, and help you guide clients that way. So when they go to look at the property, they already have that. They already know what the payment is. Now it's, do I like the house? So, um,
I think that's one key factor. We have people that, especially with condos, I would say, getting
mhm.
those calculations done before you put an offer in,
Yeah,
it's important, I would say,
yeah,
so that you know exactly what you're going to pay per month with the association fee, in addition to the taxes and insurance that might be involved in the payment.
yeah. And the HOA, the condo fees, which can
Yeah.
sometimes be pretty high, um, and we factor that in as well. That's a separate payment, not part of the mortgage, but it's an expense. So I give a breakdown of what the payment is, and then what the HOA fee is, and then the total payment there. Um, and let's see, another factor. Yes, how long do I plan on owning the home? Um, that's a great question, because there's a 30-year fixed rate. There's also adjustable rate mortgages, which I don't really sell too often. Um, but where the payment's fixed for either 5 years or 7 years, so the rate's lower, with the ability to refinance within 5 or 7 years. Um, don't do a lot of those, and typically it's not a big difference in rate, so it's a little safer to go with 30-year fixed, and also rates will be coming down at some point. We're hoping next year, so to take that risk, typically it's better just to do a 30-year fixed. Um, let's see, other additional closing costs owning home. Okay, so closing costs, and that's something I do as well when we go over your initial monthly payment, based on the taxes. So when you buy a home, you're going to have your attorney fees. You're going to have something called title insurance. It's a one-time fee that the attorney gets for you. And then the biggest thing that drives up closing costs are your prepaid property taxes. So
Mm.
at closing, now when you pay your mortgage every month, it's going to include your property taxes and your home insurance and mortgage insurance if you're putting less than 20% down. Um, the bank will collect, think of it like a security deposit. The bank's going to collect about 6, 7, 8 months of your property taxes at closing. Um, Part of that goes back to the seller, because they paid right now. They paid to the end of June, so you're going to pay whatever they pay to the town to the end of June or end of December, and then you're
Yeah.
going to pay your escrow, which the bank holds on to, this escrow fund. Um, so you're always about 6 months ahead on your taxes, and you're always like 1 year ahead on your home insurance. So when you at closing, even though that your monthly payment includes tax and insurance and everything, you're paying ahead of taxes in your insurance, and it goes into this escrow fund that the bank holds on to. And one day you get that back. If you ever refinance or move, you get that money back. But they keep that cushion, and every month when you pay your mortgage, the bank is collecting another month of home insurance and taxes going into that fund. And then when the taxes are due twice a year, they pay that out of that fund. But you're always replenishing that fund every month. So
Yeah.
that drives up closing costs a lot. I mean, if you're looking at like a home that has 6,000 in annual taxes, your total closing cost could be like 12,000 in that ballpark, with everything: attorney fees, prepaid taxes, prepaid home insurance. So and there's different ways we can fund that. So we'll get into that in a sec. Like the assistance programs, and how do we help with down payment and closing costs. Um, and just think of it closing. So you have your down payment, and then you have closing costs. They're separate. Closing costs are costs to get financing. So
Yeah.
if you're doing 5% down, you have additional, 12,000, 14,000, depending on what the taxes are. in addition to your down payment. So budgeting for that, or getting some assistance, which we'll talk about to cover that.
Yeah, I would say the taxes definitely in the certain towns, like people don't realize that. Like the one thing they should be familiar with the mill rates, the tax rates in these towns, because you think you're going to a town, it's a certain rate and it's not that bad, but then when you do the calculations with the taxes in it, then it becomes sometimes unaffordable to people.
Mm-hmm. Yeah. Let's see. Did I hit all the marks on that one, Pego? Let me see.
Oh, I think you did.
Yeah.
Go to the next slide.
Awesome. Qualifying for a mortgage. Yes. So, yeah. So there's income, there's credit, obviously, and then your debts. I get this asked a lot. So when people are buying a home, they go, "Oh, you know what? I have an extra 5,000, or my mom or dad or uncle is going to give me an extra 5,000, and how much does that change my payment?" Well, honestly, it doesn't change your payment much at all, because the payment's stretched over 30 years. It doesn't really change your payment much at all. The biggest thing you can do for your buying power is debt, paying off debt. Sometimes it's even a small credit card. And that's one of the things I look at when I'm pre-approving somebody. I say, well, here's your buying power as is. And if you can pay off this $100 credit card or this installment loan of, if it's relatively small balance, here's what you qualify for. There's different rules though. If it's with conventional and you have an installment loan, it's less than 10 payments remaining, we don't count that. But so that doesn't hurt you. But paying off debt really boosts your buying power. So it's always good to start looking, if you want to buy a home, 6-8 months out, and then that's one of the things we'll review, your buying power. If this is paid down over the next couple of months, here's your buying power now. And that's just a good idea to do, because once you have a mortgage, you think about your monthly cash outlay. You have a mortgage, and then you have this, and getting rid of not having one of those payments anymore. Now you have more money left over for everything else, groceries and stuff like that, or maybe some repairs in the home. So we would really go over that, put a plan together. And some people say, I'm ready now. Some people say, you know what, even though I don't have too much debt, I still want to save up a little bit more just as a cushion, as some reserves. So, we think about all those things, and really get you prepped and ready, and comfortable as much as you can be, to make the move. So, yeah. So income, your debts, credit, employment history. Employment history is important. Now, you can switch jobs in the same field, and honestly, sometimes we can even build a case where you make a career change. It's case by case, but sometimes it's not a big deal. But always let me know. But you can. We've had people where they said, you know what, I'm 2 weeks into the loan process, but I got this job offer, and it's going to pay me more. That's fine. We just need your job offer letter, and it won't hinder your buying process. We can move things really quickly. All our underwriting and processes and everything's in house. We're not mortgage brokers. We don't send your file out to other banks and have them underwrite it. We control the whole process, so we can change on a dime. So if that job offer does come in and right in the middle of the loan process, take it. So.
I just
One
had
thing
one question, clarify. For that job
yeah,
offer, does it have, it could be to a different company, right? But in the same field.
yeah, oh yeah, yeah, yeah. You want to be the same field, ideally. Um, Sometimes it's a different field, but the job duties are relatable, and it's not. You don't want to go from a W-2 to self-employed. You don't want to go from a W-2 to 1099. If you go from a W-2 to 1099 or self-employed, the 2-year requirement kicks in where they
Ah,
want
okay.
to, yeah, because the 1099 or self-employed, now you're filing tax returns. And the bank needs to average your tax returns over 2 years. They need to average your net profit, not your gross, but your net after expenses. So if we have any self-employed borrowers on here, that's how that works. It's a 2-year average of your net profit and after expenses. If you've been in business more than 5 years, we only need 1 year of tax returns. But if you go from a self-employed job and last year or this beginning of this year you went to W-2, we'll use your W-2 income right away, as long as the duties and jobs are relatable. So
Okay.
if you were like in construction and then you went to work for if you're self-employed, and then you work for a company where you're doing the same type of work, that's okay. So, but going the other way around, then you have to wait. Also, unemployment history, gaps in employment, which sometimes happens. If you have any unemployment in between the 2-year history, that's fine. Depending on the loan program, for instance, FHA, if you have a gap of 6 months or more, then you have to wait you have to be back working 6 months in order to get FHA financing. And then you also have to prove that you have a 2-year history of employment history prior to the job gap. If you have multiple job changes, companies, once you get to like 5 or 6 or 7, then we have to be careful with some of the loan programs. That's kind of makes the underwriter a little weary.
Okay.
They're looking for stability in your job history. So, but gaps, we've had gaps, and we just explain them. What happened. Maybe you tried to go self-employed and tried something, and it didn't work out quite yet, and you went back to the W-2. So most of it is case by case. So we just put a strong file together, a lot of explanations, letters of explanations, and build a case, for those circumstances. Pickle number 5. Let's see. And what is that? Oh, that's yeah. I mean, I guess property types, perhaps. I can touch on that.
Yeah, probably difference between like single family, multifamily,
Mhm.
like probably commercial versus like just residential, like
Yeah,
well qualified for that.
yeah. So we lend on 1 to 4 unit properties, and then any 5 units or more, that's commercial. And we have outlets for that too. We can recommend. Um, but FHA, for instance, is 3.5% down on a 1 to 4 family. And then conventional is as little as 3% down on a single, and then 5% down on a multi, 2 to 4 unit. So um, people sometimes ask, FHA, conventional, what's better? It depends on your situation. Depends on your credit score. It depends. Generally, a lower credit score will be FHA with a small down payment. Typically, 680 credit score is the mark. Um, Sellers generally like to see a conventional pre-approval over FHA because of the appraisal conditions that FHA put on, as far as the condition of the property, chipping paint, missing handrails and stuff like that. And most sellers don't want to be bothered. But if you're offering a good price, we can get you get your offer accepted with FHA.
Yeah.
Um, um, I'll touch on loan programs too after that, but yeah, so properties is 1 to 4 unit. So, and condos as well. Condos,
Yeah.
it's a single family. So, um, once in a while, there's some unique properties, 4 unit condos, which we can do, mixed use properties, we can do, depending on the square footage of the commercial versus residential. Yeah, so those are, generally it's you're either FHA, conventional. We have VA for veterans,
Yeah.
100% financing. We have USDA in more rural properties, like up in Litchfield County, Monroe, 100% financing. And we offer renovation on all these products. So VA, USDA, homes that need work, we can add the renovation piece to any of our products now. Down payment. So we went over down payment, closing costs, your prepaids, cash reserves. It's case by case. If you're buying a multifamily, a 3 or 4 unit with FHA, there's something called a 3-month reserve requirement, and basically on top of your down payment and your closing costs, the bank wants to see that you have at least 3 months of payments, not liquid. It could be in a 401k or retirement, but at least 3 months of payments somewhere to cover, for those 3 months. So typically reserves come into like jumbo mortgages, like the big mortgages, but sometimes you need them unconventional depending on the overall profile of the file.
Yep.
So
Yeah, we lost Robert.
products pick up.
We lost you for a second.
Oh,
Okay.
I think if
You're
you want
back
to go
on.
to, so I think we're good on that. And then if you want to go to mortgage products,
Yeah.
I got ahead of myself there. Conventional USDA, which is that rural property. So it's properties, like in Litchfield County up that way. Some parts of Fairfield County up top, kind of dips down. Pretty cool product. I mean, it's 100% financing, so you don't have to be, it could be anyone. First time home buyer, it doesn't have to be a veteran. And they have some renovation loans. We can add the renovation piece to that. FHA we discussed, which is the 3.5% down payment. And then down payment assistance, which we're going to get into on the next slide, which is the Connecticut Housing, the CHFA. And down payment assistance is strictly for first-time home buyers only. So first-time home buyer is anyone who hasn't owned a property in the last 3 years. So if you own the property over 3 years ago, you're a first-time home buyer again.
But how about what if you're married and your spouse owns the property, but you don't own it? You're not on the deed.
Yeah, you are a first-time home buyer. Yes.
Okay.
If you're not in the mortgage or a deed, you are a first-time home buyer. So, and sometimes clients say, "Well, we file a joint tax return." It's okay. So, the husband, let's say, if the husband is not a first-time home buyer, he's not in the mortgage. I mean, he is a first-time home buyer. He's not in the mortgage or the deed. He can buy something as a first-time home buyer, regardless if they file joint tax returns. Yep. So that's actually another misconception. So it's only whoever's on the mortgage. So sometimes that happens, and whether you want to sell the place that you own, we just have to know, what are you going to do with that other property, even though it's not yours, but we just need to know. It doesn't affect the mortgage process at all. So
Okay.
that I get that a lot. Yeah. I think that might be helpful. Because being a first-time home buyer, there's some advantages with the interest rate. With we'll get into the Connecticut Housing Program next.
All right.
Yes. So Connecticut Housing Finance Authority, we call it CHFA, CHFA. The previous slide, which we showed you the loan programs. So under Connecticut Housing, and we're a partner with them. We underwrite and do all the loans. So they offer the same loans as that previous slide. They offer conventional, FHA, USDA, and VA. But under their umbrella, the rates are lower, typically about 1% lower than national average. And this is a program I mentioned that does not hurt you if you have lower credit scores. You get the same low rate as if you had an 800 credit score. Fantastic program for first-time home buyers. I go to this one a lot because it's the rate. Closing costs are discounted if you get mortgage insurance, It's also discounted. You get a discounted rate, unless it's FHA. FHA has a standard um, fixed payment. But there's so many benefits to these programs. The other benefit is not only just the low rate, is the assistance. So the first one there, down payment assistance program, up until last year was pretty nice. It was $20,000 at a 1% rate, for 30 years, which is pretty cool. But now this year, it's now a maximum of 4% of the sale price. So if your purchase price is 300,000, the max you can get is 12,000. It's at a rate of 5% for 30-year fixed. Still a benefit.
Yeah.
People, the biggest thing that people don't like is, oh, I have a second payment. It's a second mortgage. But the payment's not that bad. And if you're short funds, and it's definitely it definitely can help you. Because you have your down payment, and your closing costs. It could be used for down payment and remainder towards closing costs. You can split it most of the time, because the way it's structured now at a 4% max, or 15,000, whichever is less. Generally, it's applied to a down payment, but we can, if your down payment is less than 15,000, we'll use the rest towards closing costs. So it's pretty nice. Not as nice as it used to be, but and then it's a small payment, so that's something you can pay off pretty quickly. You can pay extra towards it and pay it off fast. There's no prepayment penalty. So there's some benefit there if you are short funds. So don't let it hold you back if you don't think you have enough funds. The time to own program. This is a big one. It's been around for, I think, almost 2 years now, going into once you get to June. Right now, the fund is down to 11 million. It was replenished probably 5 times, 6 times, which I'm kind of shocked, but
Yeah.
it goes pretty quick. Right now, it hasn't been going as fast because there's just not a lot of inventory, but there's 11 million left of the fund, and that'll probably last into the beginning of June, mid-June, if I had to guess.
Yeah.
Um, it's a 0%, so it's fully forgiven after 10 years. So unlike the down payment assistance loan, and by the way, you cannot combine these two. They changed that as well, but we used to combine the down payment.
Oh, you can't do anymore? Oh man.
No, as of March 1st. We were combining them, and really, I mean, however, the time to own is a big amount. It's anywhere from 25,000 to 50,000. Um, Generally, in the nicer areas of towns, better school systems, it's 50,000. Um, what determines that is I usually just get the address. There's a map on their website, but it's so tedious. It's so hard to figure out. So generally, when my clients are home shopping, I say, what's the address? I'll go in their system and see what zone it's in. If it's a 25,000 or 50,000, it has income limits. So CHFA in general has income limits. You can't make a certain amount of income. Time to own has its own income limits, and that's posted on their website. There's 2 tiers to it. Fairfield County, the income limits are higher than New Haven County and the rest of the counties. Um, if your income is below the first tier, you get the full 25,000 or 50,000. If your income falls between the first tier and the second tier, you get 75% of the 25,000 or 50,000.
Mm.
So 18,750 or 37,250 or something like that. But you can use that towards your down payment and closing costs. And sometimes, if your income's low enough, and for instance, if you're in a 25,000 grant zone, or even 50,000, that can cover your down payment and closing costs. So you can get into a property with nothing other than your home inspection upfront and your appraisal. And if we're using all those funds for your down payment and closing costs, generally you'll give a deposit on your offer of a couple
Okay.
thousand, that can be returned to you at closing. And this time to own could cover all that. And again, it's fully forgiven after 10 years. Um, if you sell a property or refinance within the 10 years, it's prorated. So let's say in 5 years you go to sell your home and you're in a 25,000 grant zone and you utilize a full 25, you'll have to pay them back to 12,500. It comes out of your proceeds. So it's
Yep.
still a benefit. It's still you still benefit from the program. After 10 years, it's fully forgiven. So pretty nice. Pretty nice.
I have
Did
one
quite
quick
a,
question,
yeah.
in relation to like, say for example, you're getting $25,000 for down payment assistance. How much, say if someone to put a little bit more, like what's the limit can they put on for their own percentage for the down payment?
Yeah, good
Is there a
question.
limit how much they could? Yeah.
There is not. I've had a client who bought in North Haven and they got, by the way, North Haven, Milford, Shelton is pretty much majority of it is 50,000 zones.
Mhm.
Um, good school systems. And he bought North Haven and used the 50,000 towards down payment, and it was almost 20% of his down payment. So he put in an extra, like I think 10 or 12,000 to make it full 20% down, and
Okay.
he avoided the mortgage insurance. But you can put as much as you want down. The biggest thing is as long as you're under the income limits, um, you're good, and it doesn't matter if you have 100K in the bank and you don't want to use it.
Okay.
It's based on your income. So, but I've had clients do that. Yep, or some have used the full time to own for down payment and said, I'll just pay my own closing costs. I have the money, and they're getting their mortgage as low as possible using that money for down payment. So, pretty nice program. I don't know if it's going to get replenished again.
Yep.
Every time it runs out, I go, "There's no way they're going to do it again." I'm like, where's this money coming from? um, but yeah. Anyway, I mean, whether they do that again, there has been talks over the last year and a half of doing something more permanent. I don't think it'll be as much as the 25 or 50,000, but there have been talks of it doing something permanent. But those are just talks. Um, the time to own. It's only for Connecticut residents. You have to have lived here for 3 years and filed taxes in Connecticut for 3 years to get to apply for this time to own with us, or in general. That's their guideline. The down payment assistance loan, you could be out of state, so that you don't have to be a Connecticut resident. So we have a lot of New York buyers coming here to buy, and we can get them the CHFA program and the down payment assistance. They just can't get time to own.
Okay. I know we kind of talked about this already, kind of like the money that we need to
Hmm.
close.
Yeah. So typically, that's a good touch to touch on again. On the buyer side, what do I need up front? So generally up front, if you're getting assistance, great. But there's a couple out of pocket costs that are not part of your closing costs. They're paid up front. One is your earnest money, which is your deposit on the contract, and that's usually negotiable, right, Pago? Usually,
Yep.
you know, um, and your home inspection, which generally is, I think, Pago, what, $600 or more?
Home inspection, it depends on the square footage. So everybody charges kind
Mhm.
of different. It definitely
Mhm.
is between like right now people are paying like 450 to like 600, I would say. Yeah,
Okay.
especially if it's multi-unit, then you're gonna pay more because like that's more square footage to inspect.
Yeah. 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 And then, so the inspection lets if the property is structurally sound. They really go through it. The appraisal is something that we order. So once the inspection's done, we order the appraisal through a third party. We charge your credit card. It's about $570, and a little different than inspection. It's just it lets us know the value of the property.
Yep.
True value. Make sure you're not overpaying for the home. And yes, so those are kind of your three upfront costs. And again, if you're getting time to own or anything like that, any assistance, that earnest money will be returned to you at closing, which is pretty cool. Yep. And of course, down payment there's a wide range of down payments, but typically the minimum down payment, FHA is 3.5% of the purchase price, and the conventional is 3% on single and 5% on multis. And then I think the last one there, Pico, is like a seller credit.
Okay. Yep.
Closing buyer seller.
Sorry.
So it's not as common now because the sellers kind of have the upper hand. Although I still see some credits from the seller. Sellers are just they have multiple offers. Not any buyers hardly are asking for a seller credit where the seller is going to, you ask the seller to pay some of your closing costs. They have the upper hand right now. But after inspections are done, sometimes you can say, well, we want this or this fixed, and the seller might not want them or not want to fix them and say, oh, well, I'll just give you a $2,000 or $4,000 seller credit, and now go
Yep.
towards your closing costs. So, how we have your down payment, you have your closing costs, it'll just be less that you're bringing to closing in 30 days. So,
Yeah, I would say on my side, yeah, usually you don't see the closing cost credit. I would say for most buyers, you probably, if the property has to be on the market for a significant amount of time to kind of adhere
yeah,
to ask that. Yeah, we're not doing that within like the 5 day, 14
yeah,
day window. Yeah, that'll just, your offer will just be, they'll be read and presented, but ignored by the seller.
yeah, yeah. Cool. And then let's see the next slide. This is nice. If you guys take a screenshot of this, this is so just like I mentioned, Credit Karma, it's a free website. It gives you a lot of knowledge as far as what to do. What affects your credit the most, and what you can do to keep your scores staying high. Keeping them up. Biggest thing is your credit card utilization. Um, Keeping those balances very, very low. It doesn't matter how many credit cards you have. We don't really care about that. It's just the balances. So if you carry a balance on your credit card, even though you're paying on time, but if you keep a balance over 50% of the limit, your scores will drop every month.
Mhm.
So you want to keep them ideally under 25%. It was 30%, now it's 25, and some of the programs I look at now, it's actually 15%, which is like, why do you even have a credit card? I mean, what are you what are you gonna do with that? Especially around Christmas time, like, what are you gonna do? But you just don't want to keep them. You want to attack that and keep those low. Um, doesn't matter how many you have. Two or three are good. Um,
Yep.
that's plenty. If you go to a store, as they say Macy's, or I got asked this where I was at Banana Republic, and they go, hey, you can say 20% on this if you want to open up a card. I go, no, thanks. You're gonna pull my credit. I have enough credit. I'm good. Yeah, I'll say 20%, but now you're gonna ding my credit. So don't do that. Two or three cards is enough. Um, and that goes for, of course, the do's and don'ts during the loan process. Do not have your credit pulled. Don't get excited and say, you know what, I'm approved. Robert told me I'm approved. I'm gonna hit Raymore and Flanagan. I get that couch now, and they're gonna pull your credit, and then we get alerted prior to closing that you had your credit pulled, and then we need a copy of that bill. And oh my gosh, I got a payment now that we didn't factor in, and now you don't qualify because your debt ratio went up. You're too high to qualify. So
Mhm.
just wait until you after you close, whether it's a car or furniture. But this slide here is pretty nice. So a lot of it's common sense, but if you all can take a screenshot of that. And again, a lot of this stuff is on Credit Karma. Credit Karma is a nice site. Just don't be upset when you see your high scores, and then I pull your scores. And go, Robert, will you tell me my scores are lower? My Credit Karma is this, but you can use it as a guide. It's very helpful. Yeah, maintaining credit scores. Yes, obviously, if you don't have auto pay on your credit cards, do auto pay. You go on vacation, you get busy and you come back and like, yeah, I paid that, and you forgot. Oh, you know what? I never made that payment. Set up auto pay. It'll take the minimum payment if you forget to pay. Set up on all your accounts. Um, keep your credit really, really low. Um, I mean your balance is very, very low. Um, Paying down installment loans. I had a client, or once in a while, I have clients tell me, I have an installment loan. Let me just pay that off. I'm like, wait, don't pay that off. That could possibly drop your scores, depending on what is open. Because now your credit scores are based on what's open. So if you have an old collection, even though it's paid off and it's zero, it's staying on your credit for 7 years, and it's still kind of holding your scores down a little bit. But if you pay, let's say you have two credit cards, an installment loan, and that's all you have, and you have some
Yeah.
past blemishes, you pay that car off, your scores will probably drop because now that credit history is gone, and it's this negative stuff in the past it's kind of hindering you. So, not always the best case to pay it off. It just depends on how much you have open, but that's something I would give you guidance on too during pre-approval process. Yeah, this is a good slide to know. Um, let's see, paying your bills on time or early. Um, knowing when your credit card billing cycle ends is important because that's when they're going to hit you with interest.
Yeah.
You want to sometimes even make two payments a month, but they'll charge you less interest. Little by little, you're paying a little bit less interest. And obviously, if you can do it, pay them off, pay it off in full, so you don't get any interest. But this is a good slide too. Couple helpful tips there. Bigger, we can go to credit myths.
Yep. We talked about this.
Yeah.
Oh, don't coincide loans. We haven't talked about that one.
Yeah. And most people know this, or maybe not. Robert told me to pay these cards off, and it'll increase my score. Do not close those accounts. So remember, that'll drop your scores. So remember how I said that your scores are based on what's open. So
Yeah.
the longer your credit card has been open, the more it's helping you. So sometimes clients say, well, I just closed it. It's so old. I wasn't using it anymore. And then boom, I closed it and my scores drop because now whatever, if you have negative things on there too in the past, so you want to keep them cards open. If there's zero for 2-3 months, charge $10 on it because they will automatically close them on you. So maybe do an auto pay or something like a recurring payment, like a gym membership or something, and just use that card, and they'll never close it. So yeah, don't close the credit cards. Now, if you had a bad payment history, late in the last couple of months or 2 years, it might be a good idea to close it, depending on the history. But yeah, generally don't close your credit card accounts. I want to touch on authorized user accounts, which can sometimes help your scores. So if you don't have any credit scores or you have low credit scores, you can add yourself as an authorized user to somebody who has good credit history, a good account. You don't want to add it to where the balance is high, but if they have a credit card, a family member has a credit card for a long time, low balance history, adding you to their credit card there's no negative effect on the card holder. If you get the credit card, obviously don't use it. Just give it back to the card holder. But all that credit history will go on your credit, and you'll get a good jump in your scores in as little as 2 or 3 weeks. Of course, you want to have a card with a low balance and that's been open a long time. That can help you. If you have an authorized user account and the balance is high over time, it's actually hurting your score. So take yourself off that. Yeah.
One quick follow-up question, like, well, like, what's your experience in terms of, like, people put like their minors on, like, in terms of like with
That's
that?
great.
Like,
That's a
yeah,
fantastic idea. So, obviously we're not going to give the minor a credit card or anybody
yeah,
who's authorized user. Don't let them have the card. They don't need it. Um, but all that credit history is going to, especially if you're young. Um, when I was in college, they were giving out credit cards in the bookstore like hotcakes, and
oh yeah,
when you're young, you're like, yeah, this is, and then you get your bill and you're like, wait, there's no way I charge that much. Um, but the kids don't have the control over what but it's a great way to build credit. Yeah, I definitely recommend that, doing that for teenagers or kids in college. Just put them on your card as an authorized user, and then they come into college and they have 800 scores and they did nothing,
yeah,
and hopefully they follow my mom and dad's traits of paying on time. But that's a great way to get them going early, and maybe even buying a property early in their 20s.
yeah.
So yeah, yeah, don't pay. I mean, paying off a loan is good. It's gonna depends on um, what's open. So you know, um, sometimes paying it off and close in like an auto loan, for instance, it could help your scores depending on your overall credit profile. So it's not always a bad thing once it's paid off, but depends on your whole credit profile and past history. Opening new credit will hurt your score initially. Number 4 there, initially. So there's a credit pull, which can drop your scores. And let's say it's a auto loan. So initially, it could hurt your scores a little bit. Long term, there's going to be a benefit. But this is kind of similar to the credit cards. The auto loan is based on the starting loan amount, which is going to be high. So you buy a car for $30,000 and you got a loan for 30,000. Initially, you're going to take that hit because that relationship between the balance and the where you started from is high. But as you pay
Yeah.
it down and on time, it's going to boost your scores. So initially, opening a new loan can drop your scores a little bit, but they quickly come back. So um, it's a long-term benefit. Um, oh, be careful when you're car shopping, by the way, especially used cars. The guy says, yeah, let's pull your credit. They don't tell you they're going to pull it like 8, 9, 12 times with all their creditors.
Uh,
Yeah. I've seen people, I'm like, what happened? I say, oh, I went car shop, they pulled my credit. Like, did they tell you how many times? No. Um, be careful when you car shop. And be adamant, you don't need to pull my credit that many times. So, um, yeah, having too much credit can hurt your scores. No, the more accounts, the more open accounts in good standing. It's helping your scores. So, um, be careful with credit cards that have the annual payment. You know,
yeah.
it's good to have. Sometimes it might be all you can get. You can even get a prepaid card if your scores are really low. If your scores are in the 500s, under 600, don't apply for a credit card. You're most likely going to get denied and drop your scores.
Mm,
Get a secure prepaid card where it's pretty much guaranteed. You prepay. Doesn't matter the limit, 2, 3, 400, 150. You don't even have to use it to build credit. You can use it for $10, but you'll get it. Even if you don't use it, you'll get a current payment every month. Um, yeah, but having too much is not going to. If you have a low credit scores, you want to get like a secure prepaid card. Capital One has them. You can just Google them. Credit Karma has, if you go on Credit Karma, they'll give you some tips and some cards that they seem fit, that are good for you. And you can try that as well. Let's see. Yes, we have a credit tool. I love it. I use it a lot. I used it for, gosh, so many reasons. Or we have a credit boost system. It's free. So let's say you're FHA and we got to get you to conventional, and you're a 670 score or a 650 score, 640. We have a simulator that will say, okay, do this, this, and this, and pay this down, do this, and here's your projected score. And then within a week, depending on how aggressive you are and what's needed to pay down the debt or pay this off or pay that down, we give you that boost. And then now you go from FHA to conventional. Your pre-approval is stronger. You're more have a more chance of getting your offer accepted. I've used it even for mortgage insurance on credit, on conventional mortgages, where a guy had, I was just really helping him out. He had a 735 score, which is fantastic. But once you get over 740, the mortgage insurance became less. So I said, you know what?
Mm.
We have some time before closing. If you want to pay down this card to here, I'll do a rapid rescore, which takes about 5 days, 4 days. And he was just so thankful. And I still work with him to this day. But save the money. Any little bit we can do to help you. Now, again, if you're going CHFAs, sometimes the credit score doesn't really matter as much. But
Yeah.
unless you're trying to get into conventional. But it's a free service that we offer, and it's pretty quick. We can do things in about 4 days for a credit boost. Pretty nice. And let's see, private mortgage insurance. That's more on the conventional side. So the PMI, and that's basically if you're not putting 20% down on the mortgage, the bank will charge you an additional monthly payment. It's not that bad. That we use all 6 major carriers for the mortgage insurance. They've gotten very competitive over the years, and it's based on your down payment amount, what the premium is going to be based on your credit score. Obviously, the higher your credit score, the lower the premium. Debt ratio also affects the PMI premium. 3% down, 5% down, 10% down, 15% down, affects the premium based on 5% increments, or from 3% to 5 to 10 to 15. But your credit score affects what that's going to be. On the conventional side, the mortgage insurance isn't for life. So as you pay down your mortgage, once your mortgage balance reaches 78% of what you bought it for, it automatically falls off. I generally give advice where you want to get rid of that sooner. One is make extra payments on your mortgage every month. $50, $100, $200 towards principal. You'll save tens of thousands of dollars over the life of your mortgage by paying just $100 or $200 extra towards your principal if you can do it. But you'll also get rid of that mortgage insurance premium faster. And you'll also be able to refinance when rates drop. You're going to build equity. You're going to be paying down your debt, and generally you don't have to wait for it to automatically fall off. So there's 2 ways to get rid of mortgage insurance. You can wait for it to automatically fall off once your loan balance reaches 78% of what you bought it for, or 9 out of 10 times you get rid of it sooner because your property value is going up. You're paying down your mortgage, whether or not you're making extra payments, but you're building equity, and then at that point, it's kind of up to you to monitor it. So your neighbor across the street is selling his house for this much. I'm like, well, I owe here. I think I have 20% equity. If you think you have 20% equity, you can call the mortgage company and say, I think I can get rid of this. And they'll do their own analysis, or they might just say, get us an appraisal and send it in to us. And you may be able to get rid of that sooner. Sometimes a lot sooner. So it's not forever. FHA mortgage insurance is a little different. It's not really called PMI, um, but it's still mortgage insurance. That's for the life of the mortgage, so it never goes away, which is awful. But you'll be able to refinance. Generally, people who are FHA, post closing, we're still going to talk. I'm still going to be there for you, giving you guidance. You got a house, your credit score was 620. Give you some advice to get your scores up, because one day you're going to want to refinance. Let's get your scores up over 680, ideally over 700. And when it's time to refinance, we'll get rid of that. One, we'll refinance into conventional, get rid of that mortgage insurance for life, have a smaller mortgage insurance payment, probably a better, because you have a better credit score, and a lower rate. So, FHA isn't the end of the world, but it gets you into the home, and you'll be able to refinance at some point, you know.
Yeah.
Um, let's see, do's and don'ts. Yes, we touched on it. Don't open any new credit.
Yeah.
Yeah, don't move money around between accounts, unless we already verified. We have, you don't have to move um, money from one account to the other. Let's say, unless of course, at the end you want to do one check for your closing costs, but you don't have to move. If anything you do with money, reach out to me. You don't want to do any cash deposits. If you have money coming from gift from a relative, that's fine. But anything that you have outside of what's in your account, let me know, or let your loan officer know. Just don't
How
move
how
any.
should
Uh-huh.
how should people handle, like, Venmos, Cash App, like going out with people and stuff like that, like when you go to the restaurant, whatever, and you're
Yeah.
sending out payments for these things?
Yeah. Um, that's fine. Depends on the program. You just want to be careful. Um, they look for recurring payments, and especially with Connecticut housing loans, CHFA, they're gonna scrutinize. They're gonna question, what's this. This payment to Joe, this payment to Joe. And it's like, well, that's my cousin. Everything's explainable.
Yeah.
But they see a recurring payment every month that's not on your credit. Like, what are you paying every single month? I'm like, oh, I pay my brother's car. I'm like, oh no, coming out of your account. Maybe we can explain it. We have to get your brother's car note. Is it in his name? No, it's in my name. Oh no, but it's not showing on my credit. I'm like, okay, that's a problem. Um, but you just want to be careful. You have to live a little bit more carefully during the loan process and how you move money around. So one of the things I do when I review W-2s and tax returns is the bank statements, and we kind of nip that in the bud early. Okay, what are these uh, recurring payments, or what are these payments? And they're explainable. So we put a little note in the file, and then you can live normally most of the time during the loan process, as far as your accounts. Sometimes you can't. Sometimes you gotta just don't move too much money around, because it's going to cause too many red flags. But I give you that guidance up front. Um,
I know some people that like do like susus, like I don't know,
yeah,
like, yeah. So like
yeah,
how is that, like how like, I guess, like, would you have to like provide documentation, like, as like a gift, or like how does that work? Because
yeah. It's
it's like a savings plan, like a
yeah,
forced savings plan.
yeah. And conventional FHA is different. So conventional, all we need is a copy of the, and I don't do a regular check, do a bank check. All we need is a copy of the check, and that's
Okay.
it. We don't need it. We don't need a bank account from the SUSU. And FHA is a little bit different. FHA, we have to provide proof that that money's been in that account for 30 days. So we need a physical bank statement showing
Mm,
the money's been in there for 30 days, and then showing it coming out as well. So sometimes we need an updated printout. And sometimes the SUSU account holder doesn't want to provide that. But that's the only way with FHA. Um, we have to document it, where the money's coming from, which makes conventional, again, an easier way to go. But You know, we kind of figured that out ahead of time. Could we get a statement? Is that possible? If not, we have to do a workaround. But that's something to definitely bring up ahead of time. I've had a Susu account where they would not provide a statement, and I'm like, oh wow, we're really stuck here. Um, we had to
Yeah,
do
'cause
a little work. We had to
a
do a
lot
little
of Caribbean
workaround.
people do these things.
What's that?
Like Caribbean people, they like doing the susus. Like I
Oh
know my
yeah,
friends did
oh
it for a
yeah.
long time.
I've many accounts like that. Yep, yep. Um, yeah, and there's another name for that account too. It's the same principle. I think
Yeah,
I've had Dominican clients, Jamaican clients, and I had Cuban clients. When they had I think it's just a different name. It's the same principle.
yeah, yes, yeah,
Same,
same principle. Yeah.
yeah, um, yeah. So yeah, don't have your credit pulled for any reason. Be careful how you move money around. Um, Again, we talked about a job change, which is okay. Just let me know ahead of time. Um, oh, and as far as the job change, yeah, self-employment, yeah, that's the big. But if we went from salary to hourly, we want to be careful with that. I've had a client went from salary to hourly, and then how many hours of work a week you're working? 40. And then we got the updated pay stubs from the job at 38 hours, 35 hours. Uh-oh, you're not working 40 hours a week, and they're going to
Hmm.
average it. So in that regard, you got to be careful. Um, Going from salary to commission. Commissions is kind of like going self-employed. So
Yeah.
commission pay, self-employed pay, it's 2-year average. So um, yeah, just consult with your loan officer before you make that change. Make sure that the salary is the same, the income's the same, and the how you're paid is the same. Yeah.
Don't.
Oh, okay. Yeah, kind of touched on both of those. Yeah, yeah. Definitely do not open anything new. Don't be moving funds around. If you have funds coming from another source, let me know. Let your loan officer know. Um, and the loan officer's working for you and on your side. So, once in a while, clients are like, "Oh, I didn't want to divulge that information. I thought I was going to, uh, hinder my approval." But then at the end, we find out, and it's too late. So, um, anywhere funds are coming from, just let me know. You know, um, I'm on your side. I'm here to help you close your mortgage. Um, so let me know everything because we're going to find out anyway at some point.
Yeah. And one thing people should know too is that like when you're working with a lender, then you have your realtor there. Like we don't get your personal information, your income and stuff like that, and your credit score. Like we don't get the information. That's a communication line just between you and the lender. Like like certain updates in terms of the loan process we get, but we don't know all the ins and outs. So if you're doing certain things, like don't think that we know everything about you financially. That's between you and the loan
Yeah.
officer, Robert.
Oh yeah.
Yeah,
And that's very important. I mean, we have a fiduciary responsibility. We don't share that information um, other than what you're pre-approved for and your buying power. Yeah. Awesome. Fairway Now app. Guys, if you're still anybody fall asleep? No.
yeah, I
If you guys,
know.
it's getting late. I didn't realize
Yeah,
we're over an hour. Um,
yeah. I think we'll do the slide 18, then we'll stop there.
yeah, I get long-winded too, so I apologize. Um, the Fairway Now app is a great app. If you guys can download that, it's lots of info and it's like a mortgage calculator in there. Um, when you get a loan with us, you get all these updates on your loan process, um, post-closing information, but it's very helpful. Um, got a lot of benefits to help you. Of course, you can always reach out to me. I'm on the weekends and give me, when you want a monthly payment, and get a little bit more advice. But it's a great app. Yep, it's a great app. Use it, and it's my clients love it. They sometimes they just want to do their own payments, and it'll do mortgage insurance and all that stuff. So and then what's nice about it, during the loan process, you get all the updates. So we're big on communication during the loan process. We over communicate, and like I said, a lot of hand holding. But this app's great. Yeah, that's the home buying process there. I went ahead. Oops. Sorry, Pego.
Yeah, I think we'll stop here, Robert. Yeah, we'll stop with this
Yeah.
last slide. Yeah.
Yeah. Oh, there's a couple more. But that's just a couple more tips and stuff. Yeah.
Did you want to cover anything particular on the last couple, like, or you want to? Because this is pretty much.
That's good. I mean, we really covered everything. This is it's a lot of this. Yeah, the last two are just like the home buying process
Yeah.
from start to finish. Some tips. These are these it can be read on their own.
All right, guys. So I really want to thank Robert for taking time away from his family to go in the pool house. I know he has kids and I have kids, and he probably had, his wife probably had to put them to bed. I know that's a little iffy a little bit later when he goes back to his own bed. So I really appreciate your time taking away from your family to go for things. So
She's gonna put me to bed.
yeah. So no, Robert's a great guy. He's great to work with. His team is great too. They're pretty efficient. You get updates on everything through email and also text messages, probably through the app. So you get to know exactly what's going on with the loan process. So thanks, Robert, for presenting this information. I know not everybody's watching right now, but they will watch a lot later. They'll watch it later
Yeah.
and refresh. So I have
Excellent.
Robert's information in the comments, so you can reach out to him, reach out to his website, and apply now. Don't wait.
That's right. That's right. Get your ducks in a row.
All right. Have a good night, man. Really appreciate it.
Yeah, likewise. My pleasure. Thanks, Pego.
You're welcome.
Night.
Bye.
All right. Bye.
Good night, guys. Bedtime real estate. Go get some sleep. Go do other things. See you guys later. Bye.